In this video, we're going to discuss CRT, also known as candle range theory. The topics we'll be covering today include an introduction to CRT. We'll go over how to apply CRT, how to use CRT from a higher time frame down to a lower time frame, inverted and valid CRT models, and the different candlestick types you will come across when working with CRT. Of course, there are certain weaknesses and limitations when using the CRT model or theory. We'll also cover CRT key levels. With that said, let's begin. The first thing you need to understand is that candle range theory only requires 3 candlesticks. We have the first candlestick, the second candlestick, and then the third candlestick. This first one here will usually represent an accumulation phase. This one here, the second candlestick, must manipulate the low of the previous candlestick. On the opposite side, the second candlestick can also manipulate the high of the previous candlestick. I know I drew 2 different candlestick examples here, but I'll explain the reason for that. Now, the third candlestick is the one that must move very aggressively. That's the correct way to think about it. So it works like this. Let me clear everything. This is essentially the same concept as AMD. We consolidate, we manipulate, and then we destroy, distribute, or whatever term you prefer to use. Then we also have the CRT high and the CRT low, the CRT high and the CRT low. Here, I use this specific candlestick because even if I use this one instead, it wouldn't qualify as a valid CRT model since another high still needs to be broken. And guys, you need to remember that even if we see something like this, because I know many of you won't agree with me, we can still have a candlestick like this. This one here is a bearish candlestick. Then we have another candlestick like this, which would be a bullish candlestick. Do you realize that these two are about 99% the same? I know some of you will disagree with that, but please go and study this on your own, because this video is not about that topic. If you compare them closely, you'll notice the same intersection appearing every single time. I know many of you have watched a lot of CRT videos already, but there is a lot of missing information in those explanations. The first candlestick represents accumulation. The second candlestick represents manipulation. That means this candlestick must be present for the model to work properly. Sometimes you'll notice a wick on the third candlestick, because the third candlestick is the one you will be entering on. You'll often see that wick appear. Most of the time when people explain CRT, they tell you to trade at 50% of the candle. That doesn't work like that, guys. Price action will not always respect the 50% level. You see this wick here. Sometimes price can tap right at the open or the close. Other times, it can tap the low here. So we really only have 2 key areas, the close of the bearish candlestick and the low. You'll see these scenarios very frequently. So if you want to define your potential reversal zone or your point of interest, just make sure that this area here is included when you trade this candlestick. Even this one needs to be included. This will be your first point of interest. And then this area here will be your second point of interest. I hope this part is clear. Sometimes, however, it can look a little different. For example, on this side here, you can see that I've made it very clear. That's the reason I used 2 different examples, so I can explain everything more easily. You can see from this point that the third candlestick reacted to the high of the first candlestick. Notice that there is no 50% level respected here. Price eventually pushed strongly to the upside and respected this candlestick instead. That's how you should be thinking about it. If you understand it this way, it will be much easier. This is the higher time frame. This is the higher time frame setup. We have the first candlestick, which in this case is a bearish candlestick. Here, the 50% level can be used as the initial take profit target. The final CRT high would be your main take profit, the ultimate target. But guys, it doesn't always play out like this. You can't just enter here and expect the market to move directly to this level. Otherwise, you'll take a small 1% move while the market ends up moving more than 100%. So as you can see, with the first candlestick, we wait. The second candlestick must be bullish, and it also has to trade below this low here. Then it needs to close bullish. That's when we start waiting, because as I mentioned earlier, this area becomes your first point of interest. Then, this area here becomes your second point of interest. From there, you wait for the market to move to the upside. Since we're on the higher time frame, we now drop down to the lower time frame. This here is the lower time frame. Let's analyze this lower time frame so we can clearly understand what's happening. We can see that this level here is the CRT low, this one right here. And then we also have the CRT high located here. Now, on the lower time frame, let's say you're currently on the 4-hour chart. Then you drop down to the 15-minute chart. You'll notice that price action is essentially zoomed in. This level here will act as your first take profit 1. The CRT level will be your second take profit. From that point onward, you need to do additional analysis. You can see that we have a form of a head and shoulders pattern. I know some people will say this pattern no longer works. We also have a demand zone located here. You can take an entry here using the head and shoulders pattern, placing your stop loss here. Your first take profit would be here, and the second take profit would be at this level. Alternatively, if you want more confirmation at the demand zone, you can wait for this candlestick here to close bullish. Once this one closes bullish, you can then execute your entry. That's how you should approach this trade. Now let's move on to another example. The previous one was a bullish scenario, so now we'll look at a bearish example. It's the exact same process again. We have the first candlestick. Then we have the second candlestick. This one represents distribution, following the AMD concept. This one is the manipulation phase, and then it closes bearish. So on the lower time frame, you'll be looking to enter somewhere around this area, or possibly around this one. It really depends on how you personally want to trade it. Now let's drop down to the lower time frame and see how price behaves. On the lower time frame, you can clearly see that there's nothing happening here. This level is our CRT high, and this level here is our CRT low. Even if we take the 50% level of this range, it would bring us to around this area. However, we can also see that we have a breaker block present. Price traded above this level, then came back down and broke through it. This level here was originally a supply zone. Actually, it was a demand zone before. But once it gets broken, the market will come back to retest it as a breaker block. So when price returns to this breaker block, you can wait for the market to close bearish. You then place your stop loss above this candlestick here, either above this candle or above this one. From there, you trade to the downside. It's really that simple to understand. Now, let's move on and talk about invalid CRT versus valid CRT. For a CRT to be valid, price action must liquidate the low and then close bullish. That means this candlestick has to close while also sweeping liquidity below the low. Most of the time, this candlestick will resemble a hammer or something very similar. It doesn't necessarily have to be a perfect hammer. It just needs to be a rejection candle. And it must have this wick here to show that price has manipulated liquidity. The market might move like this, and then suddenly you'll see a sharp push to the downside, followed by a strong rejection. That's exactly the type of behavior we're looking for. We need this kind of reaction from the market. So this example here would be valid because we clearly see a rejection. Once you identify this type of pattern, it means you're allowed to trade the CRT. Now let's look at this one. This example is invalid because we don't have a wick trading below the low. We don't see that spike we're looking for. Without that liquidity sweep, the setup won't work. Price may have closed properly, but since there was no liquidity taken, this CRT is invalid. So let's move on to another example. Here, let's assume we're still on the daily time frame and we see something like this forming. This setup is not confirmed yet because the candlestick hasn't closed. Sometimes you'll notice that this candlestick might end up closing like this. But if it does that, then the setup becomes invalid, guys. That means we do not take the trade. This setup would be wrong. You'd be incorrect here. These are the types of candlesticks that can appear within a candle range theory model. Everything you see online has flaws, and you need to understand what can go wrong. That's the only way to truly master a concept. I personally like to do this kind of work. I enjoy finding a strategy that works and then identifying where it fails. I want to know exactly where it breaks down so I can understand it at a deeper level. So here we have the CRT high, and here we have the CRT low. Okay, this example here is perfect. That means on the lower time frame you'll be looking for short entries. However, on the second candlestick, the market does the exact same thing again. It breaks this candlestick, and then you'll be waiting for price to move to the upside. At this point, you'll probably feel confused about what's actually happening. What's really going on here? This is why I like to explain it this way. When you look at these two candlesticks, this part represents the past. Our main focus is not here. So here, 1, 2, 3, this is already the past. We do not focus on that. We mainly focus on what's happening right now. That's one very important thing you need to understand. To be honest with you, the real reason most people struggle is because they refuse to exit a trade and re-enter correctly. They do this because their strategy is overly complicated. But in this case, this is one thing you must clearly understand. The past. The past. This part right here. This is already done. That's what you need to keep in mind. Now let's look at the second manipulation. At this point, we are focusing entirely on this second manipulation. Here we have the candle range theory structure. Price manipulates this high using this candlestick. This is your first candle, your second candle, and then the third candle. Naturally, you'll be looking to enter the market on this third candlestick, but price trades above this level. When you see something like this, don't panic, guys. If you watch this video until the end, you'll understand why this concept is so powerful. The same thing happens here again. We have a CRT setup. Price manipulates this level. But at the moment you want to enter the market, price manipulates this area instead. Even if you were using buy limit or sell limit orders, you would get stopped out. That's exactly why I prefer to confirm my trades. It gives me an edge over traders who rely purely on buy limits and sell limits. It's always better to miss a trade than to enter one that hasn't been confirmed. So when I see something like this, I approve it. I approve this as a losing setup. Not 100%, because I know some of you will strongly disagree with me. Let's call it 60% just to stay on the safer side, because I know some of you really enjoy the comment section. Now let's move on. Let's move on to CRT key levels. CRT key levels are actually very simple to understand. These are the areas where you'll be looking to identify CRT highs and CRT lows. Most of the time, you'll find them on the higher time frame. At points of interest, supply zones, let me also say support and resistance, trend lines, Fibonacci levels, harmonic patterns, Elliott wave theory, indicators, anything. Anything you use to help you become a better trader is perfectly fine. This example here is simply a demonstration of where you'll most commonly find these levels. Okay, let's look at another example. Here you can see we have an order block. You wait, and then the market gives you a CRT high and CRT low. You also get a rejection candle here. This becomes your first candle, your second candle, and then your entry candle, the third candle. And guys, look at this closely. On the third candle, sometimes price action will return to this level. If you practice this enough, you'll notice it very often. I see many of you focusing heavily on the 50% level. I don't really understand the obsession with 50%, guys. Instead, focus on the high of the previous candlestick. I believe I've already made a video explaining that. Then price comes in and forms the same structure again, a CRT high and a CRT low. You wait for the market to spike and give you a rejection candle, a clear rejection. Once that happens, and price retraces on the lower time frame, you'll be looking for entries around the previous candlestick's high, its close, or even the open of the bearish candlestick. It really depends on your trading style. You can see here that we have the open, the close here, and then another open here. You can choose this level, this one, or this one. It's all acceptable. As long as on the lower time frame you see a pullback, followed by a zone and a confirmation candle. That confirmation candle is key. Once you get that, you can enter the trade, place your ASL, execute the position, and let the market move. Of course, all of this should be done with proper risk to reward management. Alright guys, this is my favorite part of the video, the part I've been waiting to explain. This is a bonus pattern that I really want you to study carefully. I'm going to break it down very slowly, so please pay close attention to this. We start with this bullish candlestick, followed by another bullish candlestick. Then we get the first red candle. That's our first one. Then we have the second one. On the third candlestick, price trades above the high of this candlestick. Guys, you need to know that in most cases, the fourth candlestick is usually very strong. It tends to continue in the same direction. Let me show you another example. I hope the first example made sense. Also, guys, let's say you've already entered the trade. This level here would be your invalidation point. Price is unlikely to come back and break through this area, so this becomes a safe ASL. I'm not telling you exactly where to place it, I'm just explaining the concept. I say this because I know some of you risk a lot of money and then message me afterward. When I ask to see your chart, I noticed that not all the steps were followed. Anyway, let's move on. This here is another example. We have the first candlestick, then the second candlestick. On the third one, price breaks this level. We get a break of the second candlestick, just like I mentioned earlier, right here. Then you can see this next one, which is the fourth candlestick. This level acts as the invalidation. Price is unlikely to move above it. In this example, price moved slowly at first. But look at the fifth candlestick. It was very strong. I hope you understand this part because this is not a full video on this pattern. I'm simply giving you a bonus so you can go and practice it on your own. The same concept applies here again, guys. You have 1, 2, and then the third candlestick must break this level. This one here is quite strong, but you need to wait for the final example in the video. I'll show you everything step by step in that one. So now, let me show you how this powerful pattern actually works in real time. At the moment, we can see that we have a CRT low and a CRT high. That means we'll be waiting for price to move to the downside first, so that we can look for trades to the upside. Price moves to the downside. For a safer stop loss, we can place our stop here. Let's continue. Now price moves to the upside. But what if you missed this initial trade? Then we reset the process. We identify the first candle, then the second candle, and we mark this level here. That means we now wait for the market to give us a bullish candlestick that closes below this level, below the second candlestick. Once that happens, we know the market could be gaining strength. And now we can see it clearly. Okay, the market traded below the level. So now, this is where I want to enter. And I already know that this area here will act as my invalidation. That means I wait for a retracement on the lower time frame. I'll be looking for price to move back to the upside. It's really that simple to understand. So look guys, retracement, boom, and you catch a large move using very basic trading knowledge. You don't need to master a ton of indicators or obsess over support and resistance. You just need to understand price action. Also guys, if you have any questions, feel free to message me on Telegram. It's completely free, I won't bite. I'm just a normal person like you, so there's no reason to be nervous or think I won't respond. Just go on Telegram, message the admin, and I'll get back to you. Now let's look at this last example here. We have this move right here. Let me start from the beginning so it's clear. We have the CRT low and the CRT high. Then we get the first candlestick, which represents accumulation. We have the second candlestick, which represents manipulation. Then we have the third candlestick, which is distribution. But pay close attention to the distribution candle, guys. The market actually traded above the manipulation. That means that on the third candlestick, we actually have another manipulation. So what happens next? This is one of the mistakes you're going to encounter when using CRT. This usually happens when you rely on buy limit or sell limit orders. But you don't need to be afraid of this situation. As I mentioned earlier, you can clearly identify the first manipulation, M1. Then we have the second manipulation, M2. And after that, we get a strong move. You can see here on the third candlestick that any retracement immediately leads to a strong push lower. We can also observe rejection after rejection. To the upside, the price action is weak. And look at how the market moved, very aggressive to the downside. Yes, sometimes this pattern can fail. I actually noticed that while recording this video. You can clearly see it here, 1, 2, 3. But price didn't push lower in this case. Let me find another example. 1, 2, 3. You might think this stopped you out, but no. I said the invalidation is on the first candlestick. You have to remember that, the first candlestick. Maybe I didn't explain this clearly enough before, so let me show you again. We have the first candle, then the second candle, and then we have the third candle. On the third one, we can clearly see that price traded above the high of the second candlestick. This level here is where we place our stop loss. Then, on any retracement back into this area, we look for sell opportunities. That's how the stop loss remains protected. So you can see this one is confirmed. But this example here failed. That's not a big issue. This one here is also a perfect CRT. And we also have this CRT example here. I don't think we have any more right now. So guys, I think that brings us to the end of the video. If you enjoyed it, make sure to like the video and leave a comment below with any topics you'd like me to cover next. And with that said, I'll see you in the next one.